Hi all, it's Joe Duffy, and this video is part 2 in our options series of how we use options. Okay, so the first video we covered debit spreads, which are the most straightforward, and hopefully you got your head around that. This one's a little bit difficult, or more difficult to get your head around, because what we're going to use is what's called a credit spread, and we're going to use puts. So we're going to have the same posture for our example here, and that posture is that our view is the market's going up. So we're going to set up a strategy here using puts, but we want the market to go up. Now that may seem counterintuitive because everyone knows that if you want the market to go down, you buy a put. But what we're going to do is actually we want the market to go up, so we're going to be short a put. Now, the numbers I'm going to show you here are, for example, as I sort of alluded to in the last video, there's always a best strategy in terms of the various strategies you can use with options, and the numbers can vary greatly. You'd be surprised at how much they can vary. Right now, the spread I'm going to show you is not particularly attractive by the numbers, and it's not one we would do. So keep that in mind, that this is an example of the theory, not actually the returns that we would be acceptable to us if we actually set up a spread like this. Okay, this is an example of how it works, not necessarily the numbers we would have to see in order to use it. Okay, I hope that differentiation is clear. Okay, so we want the market to go up. So, excuse me. We're going to be short the 301 put, say. Okay, if the market goes above 301, then this 576 is all ours. Okay, unfortunately, we need to cover that somehow in case the market goes against us and it goes down. So we're going to need to buy this put here, this 296 put, and it's $3.87. So we're going to buy for 387, and we're going to sell for 576, and we're going to hope the market, or expect the market's going to go above 301 in order for our strategy to pay. Because at that point, above 301, both of those are worth zero. We've collected, 576. We've only paid out 387. So we've brought $1.89 in the door to start out with. That's why they call it a credit spread, because you're getting a credit to start out with. So above 301, we collect that whole credit. Okay. Now, the market's only 296.28 right now, so the market still has to move up 5 points for us to collect that $1.89, and that's not such a great deal. And as I said, the numbers don't work here, but the example is what we're interested in. Now, if the market stayed dead straight where it is at 296.28, this 296 put is worth zero because the market's above 296, and this 301 call that we're short is going to be worth $5. Okay, so we received in $1.89. Now we have to pay back out $5, so we would lose $3.11. Not a great risk reward on that, and that's why the numbers don't particularly work for us. But like I said, the numbers can vary greatly depending on a lot of different market conditions. Okay, so let's say that the market does go up above 301, then everything's worth zero, and we pocket $1.89. Now, if the market goes down to below 296, if it goes down to 291, then the 301 is worth 10, but the 295 is worth 5, so we still lose that $5. So in that respect, much the same as the debit spread, you know what your maximum loss is, and you know what your maximum gain is. Now, if this was a more skewed to 50-50, where I could make 250 to lose 250, I would do that kind of trade because I'm pretty sure that my system is going to bat a lot higher than 50%, so I'm going to make money going forward. But risking 3 to 11 to make 189 isn't the risk reward I would do, but that's the principle of this trade. Okay, and that's how a credit spread works. All right, so we could do the same thing with calls if we were bearish on the market, but if the numbers work out, this can be a great strategy, and because it obviously puts time value in your favor. Okay, so decay starts to work for you instead of against you. And much like the debit spread, if things do go against you, the spread is going to mitigate how much you're going to lose in the short term, because it's not going to move against you nearly as much as if you just had the short call on. Okay, so if the market started to go racing up, or racing down, sorry, when you expected it to go racing up, you're going to lose a lot less money and be able to cut your loss a lot quicker for a lot less damage with the spread than you would if you had just an outright call or short put on. Okay. All right. So again, this one's a little more sophisticated. It can take a little more time to get your head around. But again, once you start trading these and once you start looking at a few examples and figuring them out for yourself, you can see exactly how they work and the advantages that they have. Okay, any questions? It's Joe at jdtradingsystems.com, Joe at jdtradingsystems.com. Thanks for listening.